So it seems Japan has reached the breaking point. For many months, the Japanese yen has been depreciating. It was losing value against the dollar, causing their import bills to surge. And the devaluation has been rather massive. Before the Fed hiked rates, the yen was at around 120 to the dollar. A week ago, it was well over 160 to the reserve currency. That's a crazy devaluation of at least 33%. Prices throughout Japan were flying through the roof and causing people to cut back on spending. It's critical to note that all the previous currency interventions have effectively failed. The yen would strengthen a bit before collapsing against the dollar down the road. But if you look at the state of Japan's economy, they have no choice but to keep intervening. The country is slipping into economic stagnation. While it's true that exports become cheaper, it's really crazy to ignore local consumption. If the yen becomes too weak, the country will still collapse because people are simply too broke. Japan will be effectively reduced to a manufacturing colony. It will be a sweatshop exporting stuff to the world. Consumer spending fell by 1.8% in May. This is a big deviation from expectations of a 0.1% growth. Why are people cutting back? Well, prices for food and other consumer goods are going up. Consider how badly Kishida is doing in the polls. He really has to find a way to reverse this disaster. But Japan's problem is structural. They can't really withstand higher rates or their debt bubble will implode. So the only strategy left is currency intervention. An endless selling of dollars to buy back the yen. It's undeniable that the big drop in the yen recently was the Bank of Japan intervening. The yellow line shows the dollar taking a massive fall against the Japanese yen 2 days back on the 11th of July. It's the same pattern as the previous two interventions in April and May. That was when the BOJ spent $61 billion worth of reserves to defend the yen. The magnitude of the drop means this intervention cost tens of billions of dollars as well. This is mission impossible because Tokyo is fighting against the tide, they're swimming against the current. As long as the Fed refuses to cut rates, the yen is doomed to 170 or even 180 against the dollar. The funny thing is that the market believes this intervention will fail just like the rest. Traders are still betting massively against the yen. The shorts are still tremendous despite all the intervention. It's at the same level as during the 07-08 financial crisis. What's sad about this is how Japan chose to hide the intervention. Kanda of the BOJ, that's a currency chief, is still playing coy about their dollar sell-off, and it's maybe due to this. Yellen has warned Japan before about currency interventions, how they have to ask for permission and communicate their actions, and how this shouldn't be a routine activity. It's a big reason why Japan timed their intervention around the US CPI report. Because US inflation fell in June, this would naturally help the yen strengthen a little. But it's ultra obvious that Japan went into the markets and propped up the yen. The move was more than 2% in a matter of hours or even minutes, which isn't natural at all. However, the BOJ has few options left. Japan's economy is on the brink of another recession once again. They have to protect the currency even if it's a losing battle. Analysts are forecasting a GDP contraction of 0.4%. That isn't good when other G7 economies like the US and even Germany are expected to grow this year. If the global economy is recovering, the numbers should be going up and not collapsing down. The real winners here are the companies and people invested in Japanese stocks. A weak yen is great for them. Take Honda for example. Their profits grew by 70% last year because of the collapsing yen. Honda exports their cars to the world in US dollars, and because of the collapsing yen, when they convert their dollars earned, their profits start to explode up. Now, this is great for Honda, but when your average Japanese person, the salary man, your salaries definitely aren't up by 30% over the last year. So you are bleeding buying power. What's important here are the implications of this currency fight. Japan's bid for US bonds is going to disappear over time. So Japan has to intervene time and time again to stabilize the yen, which means selling off their holdings. And if they don't, it kind of splits society into two. The big business owners with all the profits who pay their workers in devalued currency. It's different if you're heading to Japan for holiday, and check this out, it's totally crazy. Apparently, this sashimi dish in a Michelin restaurant costs less than $5. Dining in Japan is now dirt cheap, and that's if you're a foreigner holding US dollars. If you're local, then the price is probably higher than before thanks to inflation. Obviously, the BOJ can't let this continue forever. They will keep dumping dollars to try and protect the yen, but it won't work. The only lasting difference will be when the Federal Reserve cuts rates down by a lot. And speaking of desperation, let's talk about the US and NATO. In the recent NATO summit, the alliance made a very shocking statement. The Eye of Sauron has turned towards China now. And here's straight from the NATO communique. The PLC has become a decisive enabler of Russia's war against Ukraine through its so-called No Limits partnership and its large-scale support for Russia's defense industrial base. It's without doubt that the focus of the West is shifting from Russia towards China. We know the war in Ukraine is going to drag on for many more months or even years. The West has production issues and financial problems. You need a scapegoat to blame if the entire project falls through. I guess the US didn't expect Russia's big pivot to China.
Our conversation with Zaganov was repeated with Lebed. They talked about they don't want this NATO expansion. They know it's not in their security interests and on, and said, well, and if you do that, we may have to look to China. And I couldn't help using the colloquial expression from my state by saying to Zaganov, lots of luck in your senior year. Good luck. And if that doesn't work, try Iran. I'm serious. I said that to them, and that is not an option. And everybody knows, every one of those leaders acknowledges and needs, and they resent it. But they need to look west.
Biden sure didn't see that one coming. Russia did in fact join forces with China, especially when it comes to their economy and bilateral trade. NATO's pivot towards China is important because it opens the way for all sorts of economic sanctions. It's good to keep in mind the threats made over the last few months. We had Blinken warning Chinese industries. We also had Janet Yellen threatening sanctions on Chinese banks. Biden has jumped on the bandwagon now and he has gone off the rails and is warning China over their trade with Russia. Biden wants to punish Beijing. He's going to tell his allies in the EU to cut their investments into China. Essentially, he wants to starve Beijing of capital to prevent Western money from flowing in. And this is a very dangerous position to take, and I'm not even sure if his EU allies will agree to his claim. He is preaching economic war and effectively an embargo of investment into China. And here's why Biden is in panic mode. While the West is preparing for China to collapse, the evidence shows otherwise. China's trade surplus with the world just keeps growing. In June alone, the surplus hit an incredible $99 billion. Exports are growing even though the West is desperately trying to decouple from China trade. Business with Europe and the US definitely took a tumble, but overall exports still rose. Beijing is making more money than ever. Southeast Asia and the rest of the world, like the Middle East, are buying more from China. And as long as this continues, China is effectively sanction proof. And here's the $1 trillion question. Will Europe follow the dictates of Washington? Well, it's questionable because the EU itself is getting rather divided. Italy's Meloni is running to Beijing soon. Germany is afraid of Chinese retaliation due to the EV tariffs. Then we have Viktor Orban, who just visited President Xi. Hungary themselves clearly rejected NATO's stance against China, trying to prevent them from becoming an anti-China bloc. So there are pockets of resistance here. But let's work on the assumption that Europe follows the Americans, and it's quite possible that they might. When you are under the US security umbrella, the lines between foreign policy and economic policy really starts to blur. The big worry should be China's response to this. China could always retaliate back, especially in their EV and green investments, and those are the industries that Europe needs to survive and decarbonize their economy. Over the past 2 years, the majority of Chinese investments went to Hungary. It's no surprise considering the wonderful relationship between the two countries. If EU countries pull away their investments, the big winner will be Hungary. Their industries will start to expand and catch up with the rest of the three big economies of Europe: France, Germany, and Italy. I'm quite sure the EU knows this, and if they are smart, they would just dismiss what Biden said. Decoupling from China would be an economic disaster, doubly so if Beijing refuses to invest in your country. It's not just money coming in. When Chinese companies pump capital, they also bring in a ton of expertise and technology with them, capabilities that the Europeans simply don't have. A big question is to ask who really benefits from this decoupling. If Europe pulls their money away from China, where else are they going to invest in? Especially industrial nations like Germany. It will be the United States. Just take a look at German companies. In 2023, giants like Volkswagen and Mercedes poured billions of dollars into US projects. And that is money creating jobs on US soil, thousands of jobs. Because of higher manufacturing costs, German companies have two destinations to choose from. They can either go to their US ally where energy is cheaper, or they can choose to invest in China where you also get cheap energy plus a superior supply chain. If Biden forces Europe to cancel investments into China, it is a win for US industries. This is a zero sum game. The capital China loses will flow into American companies, and that's how Machiavellian or how cunning the entire plan really is. Now, will Europe take the bait? We simply don't know, but it's undeniable that this economic war is escalating to new heights. It goes beyond asset confiscation and sanctioning financial institutions. The US is trying to weaponize investment money itself. Now, will China take this lying down? Well, they might. Many other markets are willing to work with Beijing. They'll simply invest elsewhere. Chinese EV giant BYD just opened a plant in Thailand, and thanks to this, Thailand is one step closer to their goals. By 2030, they could become the Asian hub of EV production. Almost a million electric cars could be exported from the country, which will transform the entire economy. What Europe loses, Asian countries will gain. Either way, the US decoupling from China is all but confirmed. This battle is going to get worse and Europe might just be the collateral damage. But let me know what you think. How long can Japan defend their currency? And will the EU stop investing in China? Let me know in the comments below. Stay safe, be sure to smash the like button and subscribe as we navigate through these crazy times.